The financial markets Nifty is at 17,000 points. For anyone who's invested anywhere is definitely making a profit, right? Now the question is, what do you do with these profits? Well, this is exactly what I'm going to answer in this video and a lot more. So, my name is Arpit Arora. I'm India's leading personal finance expert and passive income coach, and I'm on that quest to help the middle class of India to think, act, and make returns like the wealthy so that they're able to live a life which is completely free of money worries and also follow their passion. So, my friends, in this very amazing video, we'll be talking about how you can also do that. So, you need to start thinking like the wealthy. What is the wealthy and the bigger financial institutions thinking right now? Are they thinking of buying more? Are they thinking of selling out? Are they thinking of booking profits? Well, as a fact right now, as of today, we see that the foreign portfolio investors are pulling out money majorly from the stock markets, which means that they're investing in other places. They have been started taking out profits. But why is it that despite foreign portfolio investors taking money out, why is the stock market still going up? Because of the domestic retail investors, the HNI investors. These are the people who are in the frenzy, who are in the euphoria of still making money out of it, which is why the stock markets continue to go up. What I want you to understand is that this is one of the key pivots to look at when every common man becomes a trader and an investor. This is the time when the smart money has already moved out from the stock markets. So you need to start following that. Now thinking about it, should you buy more? I don't think so. Should you sell out? We'll talk about it. Should you only book profits? Well, maybe. Let's learn about different strategies one can use so that they're able to get the maximum out of the gains that they've already got and still safe and secure the money that they already have. So I want you to understand some certain facts about the financial markets. The first one is the returns. When we're talking about the returns, Sensex started in 1979. From that point until 31st December 2020, the last calendar year. And what we see is that 16% is the average return. A little more than 16% is what it is already delivering. On top of this, if you look at the last 10 years, the return has been between 10 to 12%. The last 1 year or so, we have seen a double 100% jump, which is an amazing return that this financial markets have given. In a scenario like this, if you know the average return last 10 years maybe is between 12% up to 15%, overall period is 16%. A 100% jump means what? And it has already taken into account the profits that it's going to make in the next few years, which means the returns from the stock markets in the next 2 to 3 years might not be that great. If you have already invested in you making and sitting on that big gain right now, my friend, this is the time to start considering your exits. Another thing what you want to understand, another fact about the economy is that the fundamentals of the economy as we're looking at today is that the GDP is lower than the pre-COVID level as well. So if GDP was here, we are here right now. We are lower than where we were. So there is this big gap that needs to be fulfilled. As per many economists, it will take up to 2022 or 2023 to actually get there. On the contrary, we're seeing a disconnect between the GDP and the stock markets because the stock markets are at an all-time high, which again means what? That maybe this disparity is a short-term thing and this market will not be able to sustain. So you're now thinking, what does it mean especially for you? How should you go about it? What are the options that you have? So in a scenario like this, one thing that we know for sure is the market correction is long overdue, given both of the return facts and the fundamental facts that we're looking at. So what can you do? The first thing, the option that I'm going to share in front of you, I'm going to share two options, both either or you can consider, but looking at your different circumstances. But the main idea is that you have to take action on either one of them. Otherwise, you would have missed an amazing opportunity, maybe once in a lifetime opportunity for many investors. So the first option is you should think of exiting from your existing positions into equity, at least half of that. Only hold that you are thinking to hold for next 10 years, 15 or 20 years. Something that you're thinking extremely long. Any positions that are for shorter term, any positions that you're not sure about, any positions that are for not for an extra long, very long term, one should look at exactly trimming their portfolios by half or even more than that. This is one thing you should have in your mind. In case you are still wanting to hold but still want to cover yourself for the downside, the second option is even more amazing. That is known as hedge. Hedges can be done using futures and options. These are more complex styles of ensuring that if the markets go down, you get all the profits, or all the, should I explain again, if the markets go down, you get all the losses covered by the hedge. And if the markets go up, you still continue to make money. Options is one way that can help you to do that. So future and options are different methods through which you are able to hedge your existing position. So in case the market goes down, you're unaffected. In case they go up, depending on if you use a future or option, you can still make some part of the profits. The whole idea is to help you book your profits and retain the profits that you have as on this level, to simply put it that way. Okay. In both cases, you can choose either or, whatever suits, but alongside you should continue to do your monthly investments. This is one mistake I see a lot of people doing, that they try to time the market. We are not trying to time the market. We're simply trying to ensure that the gains that we've made, we're able to sustain on them. We're not taking extra risk, and we are adjusting our portfolio or investments as per what is happening in the economy. So continue to do your long-term investments. They have nothing to do with what is happening in the short term in the financial market. That is absolutely important. Now, in case you still have any further questions on this, do not forget to ask the wise guy. See, if you like this video, I definitely share it with someone who you think can benefit from this. Comment if you have any questions on this, and feel free to get in touch with us if you need more assistance. Now, I will see you in the next video. See you. Take care.